Joining us now, Christina Minnis, Goldman Sachs Global Head of Credit and Asset Finance. How's business? How would you characterize it right now? Do we need a rate cut?
I think things feel pretty good, and I think we probably do need a rate cut.
Both. Two things can be true at once.
Yeah, I do.
Liberation Day there's some trepidation, but overall, third quarter's been better.
It's been much better, and if you look at volumes in the credit markets since Liberation Day, they're up pretty meaningfully on the high yield side, and also on the loan side, we're coming up on almost flat. So the credit markets feel quite strong. Spreads are very tight, and borrowers and issuers are coming to the market. So we feel very good.
Supply's been light on both sides of the Atlantic.
Well, we've got a pickup in M&A, which is really constructive. And I know my colleague Stefan Felgois was here earlier in the summer talking about M&A being up. And I think that's a very positive sign for volumes in the credit markets because most of those transactions are being financed in the credit markets. So, 8% increase in volumes and high yield is very constructive. And we see, M&A picking up. And importantly, we see the sponsor activity picking up as well, which we're very excited about.
So this should get better if the Fed starts into a cycle, an easing cycle.
Lower cost of capital, very good for borrowers, very good for earnings. We can see that in the equity markets. And also when we think about the big investment that we need in infrastructure and what's going on in terms of energy transition and tech investment, there's a significant amount of financing need, so lower borrowing costs are really going to help that dynamic.
Do you think the Fed starting on a rate lowering cycle eventually gets to be the thing that overheats Wall Street? We never know exactly where it's coming from, but you've already got markets at new highs. If you throw more fuel onto the fire, do you risk it getting to a point where things are too good to be true?
I think there's always a risk of that strong sentiment, but I do think based on the fact that we have $4 trillion of assets sitting in sponsors that haven't traded yet, and there's a lot of pent-up demand for activity. I think investors are looking to invest. I mean, again, back to the infrastructure comment, there's a significant amount of investment needed there. People comment on $100 trillion of capital requirement there. And, investors are underweight there. A lot of alternative managers want to see 6 to 8% of their portfolio there, and they're only at 1 to 2%.
I just go back to where we were in 2001. And the Fed bringing rates all the way down after September 11th.
Well, if you take a look at where the Fed funds targets are looking at, bringing it into sort of a low 3% rate on an historic basis looks pretty reasonable. Yeah. And our own GIR team is calling for the 10-year to settle in around a 4.25%, 4.2%. So that's very different than the rate environment that we were in. Right. Where that's a very kind of historical average, which seems actually quite realistic.
It seems like we need a lot of energy.
Do
you think about that just with the data centers and AI, Bitcoin, crypto? What are you coming up with? Do you sit around, you brainiacs sit around thinking about how to finance it? Is it public-private? How do we do it?
I think, Joe, there's been a lot of discussion about the convergence of the public and private markets, and that's something us at Goldman Sachs are pretty excited about, and why we created this new area called Capital Solutions Group to put those.
So you are thinking about it. You created a whole new area for them? Is that your idea?
A whole new organization to really address our clients' needs, and that is basically because we see convergence, and we've had a lot of discussions about private credit and what's going to happen with private credit. That's now a $1 trillion market. Well, remember, the public markets between loans and bonds below investment grade are like $2.6 trillion. So one's growing at 20 to 30%. That's the private market. One's growing at 3%. And now talk about private IG, which is private investment grade, which is a lot of discussion about how private credit is going to support now this huge capital need. That's a very positive thing for our clients. And take data centers. We think there's almost $300 billion needed in just the next 2 years. And when you add compute to that, it's $1 trillion. Where's that going to come from? Historically, that's come mostly from sovereigns and bank balance sheets. Now we have this great development in private investment grade that is growing at 30% to step in. And as I said, issuers need the money. Investors want to invest. So we have a very good setup.
How can total deals be down but M&A be up so much?
Because large deals are increasing in terms of volumes. The $10 billion transactions in sponsors and in corporates are up 100%, 130% year over year.
The best you've seen in 5 years for M&A, would you say?
Best in 5 years. I'd have to defer to my colleagues at M&A, but I think it's pretty darn good.
It is,
yeah,
at this point. Hope Andrew's watching.
I know. I was kind of disappointed he wasn't here.
He's really wanted M&A. He loves M&A.
Yeah. Well, I mean, look at, the conditions for LBOs, right? One of the reasons why sponsors have been more quiet, cost of capital went up pretty significantly. Now cost of capital is coming down. That's great, which enables them to put more leverage on companies, obviously want to do it in a reasonable way, which enables them to hopefully pay more, and their weighted average cost of capital is down. So that's going to help fuel sponsor activity. We haven't talked about the equity capital markets. September was the best start since 2012. 10 IPOs last week. Goldman led 5 of them. 4 of the 5 of them priced above the initial filing range, all trading well. A functioning, constructive equity market, in particular IPO market, also gives a lot of confidence to financial sponsors that they have more than one exit when they buy a company. So we're quite optimistic.